Welcome to Skytech-Lens. It began not with a bang but with a whisper. In early 2025, China quietly imposed a 10% tariff on all U.S. crude oil imports. No announcement, no drama. The flow of American oil tankers to China stopped almost overnight. This was a calculated decoupling, not a negotiation tactic. The tariff made American oil permanently uncompetitive in China. The message: China no longer needed or wanted American oil. While Washington was distracted by its own disputes, the global energy map was being redrawn. Billions invested along the U.S. Gulf Coast now depended on a market that had vanished. China's move was strategic, avoiding confrontation but achieving a decisive shift. By letting contracts expire and quietly redirecting market forces, Beijing changed the game without headlines. The American administration missed the significance entirely. The silence from the oil trade routes was the overture to a new economic era. Few in power seemed to hear it, but the world was already moving on. The impact hit hardest on the docks of Texas and Louisiana. Once busy ports like Corpus Christi and Houston fell eerily quiet. Pipelines and storage tanks built for booming exports now stood underused. The Gulf Coast's energy infrastructure became a monument to a miscalculation. The slowdown was gradual, then undeniable. Shipping lanes cleared, terminals stilled. High-paying jobs vanished as operations scaled back. The entire logistical chain, from West Texas oil fields to coastal docks, ground to a halt. This was a new kind of economic shock, deliberate, strategic, and made half a world away. America's energy sector had bet big on China, overlooking its own vulnerability. As cranes stood idle and tankers stopped arriving, the reality set in. America had built a gateway to the world only to find the world had quietly built a new door. The Gulf Coast's silence spoke volumes about shifting global power. As American oil ports emptied, Russia, Saudi Arabia, Iran, and the UAE filled the gap. China had already secured new long-term contracts with these nations. The real revolution: these deals were settled in Chinese yuan, not US dollars. For decades, oil trade in dollars gave Washington global leverage. Now, China was dismantling the petrodollar system, one barrel at a time. Oil producers began accumulating yuan, weakening the dollar's dominance. U.S. sanctions lost their bite as nations traded outside Washington's reach. China re-engineered its refineries and payment systems to fit new suppliers. The shift was embedded in infrastructure, making the change permanent. The age of yuan-denominated oil trade had begun. The global financial order was quietly being rewritten. For American oil exporters, the consequences were immediate. Billions invested in Gulf Coast export infrastructure became stranded assets. These pipelines and terminals built for China now had no market. The petrodollar system, the bedrock of U.S. economic power, began to crack. As China and others traded oil in yuan, global demand for dollars shrank. The U.S. could no longer borrow cheaply. Deficits became harder to fund. The weaponization of the dollar had backfired, accelerating the search for alternatives. Nations quietly built systems to bypass the dollar, eroding its supremacy. There was no single event, just a steady erosion of status. China's move proved massive trade could happen without the U.S. financial system. American export investments were left useless, not by engineering failure, but by a changing financial world. The global order was shifting and the U.S. was left behind. The realignment wasn't just about China. Canada and Mexico launched the Northern Corridor, a logistics network to reroute trade with Asia and Europe, bypassing the U.S. entirely. Decades of North American integration were being undone. Billions were invested to create an economic bypass around the U.S. Canada pivoted exports to Asia and Europe, investing in its own ports. The message: Canada and Mexico would no longer let U.S. politics dictate their economic fate. The Northern Corridor was a physical sign of America's growing isolation. America First policies had encouraged its neighbors to build a North America without America. The continent's trade routes were being rewired, leaving the U.S. on the outside. The loss of trust was now built into the infrastructure. As U.S. oil was shut out, Iranian crude exports to China soared. Iran, long under U.S. sanctions, became one of China's top suppliers. A ghost fleet of tankers evaded detection, rebranding oil and using ship-to-ship transfers. Transactions were settled in yuan, outside the U.S. banking system. China's independent teapot refineries eagerly bought discounted Iranian oil. The Iran-China oil trade exposed the limits of American sanctions. Countries built alternative payment systems, blunting U.S. power. The ghost fleet was a symbol. The world was learning to ignore the old rules. China's move away from the dollar sparked a global chain reaction. India signed long-term contracts for Russian oil, paying in yuan. Southeast Asian nations sought non-dollar payment options, reducing U.S. leverage. Even Europe used the new dynamics to negotiate better deals for U.S. crude. The U.S. lost its position as price setter, buyers now had more power. The world was no longer content with a system dominated by one superpower. The shift was pragmatic, driven by a desire for stability and risk diversification. Each new non-dollar deal added another crack to the old order. The world was reorganizing into a complex multipolar network. The U.S. struggled to find its place in this new landscape. The domino effect was irreversible. As the world changed, the American administration was distracted. The president focused on old trade wars and loud disputes, missing the quiet revolution in global trade. Tariffs reached historic highs, but other countries built new supply chains, making U.S. producers irrelevant. Ports and pipelines grew idle as foreign buyers moved on. Political discourse in Washington revolved around blame, not solutions. Some accused China of funding climate lawsuits, ignoring self-inflicted wounds. Policy paralysis left America behind as the world made new deals and built new infrastructure. The administration missed the strategic maneuvers reshaping the global order. America was fighting yesterday's battles while the world moved forward. The Great Decoupling wasn't dramatic, it was a quiet, collective shift. While America clung to old narratives, others built a new, decentralized system. U.S. infrastructure and the petrodollar became relics of a bygone era. The loss was not just economic, but a blow to America's self-image. The New World Order wasn't anti-American, just post-American. Nations acted out of self-interest, seeking stability and predictability. New trade routes and alliances weren't meant to attack the U.S., but to function without it. By autumn 2025, America was just one pole in a multipolar world. Its leaders spoke the language of the past, but the world had already moved on. The silence from the oil ports was the sound of a world trading on its own terms. Thanks for watching. Subscribe the channel for more updates.